We are in the era of hype. In the old days, knowing the next big stock was reserved for a few distinguished gentlemen. But in today's market, hype moves stocks just as much as fundamentals. A viral social media post, an influencer endorsement, or even a single tweet can send the stock soaring. GameStop. This guy, Roaring Kitty, made the stock go through the roof and created chaos with some big financial institutions. And it felt good. Pump and dump schemes, such as the crypto Libra, proposed by this guy, Javier, where thousands of people bought it and within hours, insiders sold their stake and the coin's now worth virtually zero. The sudden increase in demand pushes prices even higher, even beyond what a company is actually worth. And when reality sets in, the stock can come crashing down, leaving latecomers with heavy losses. And I'm a firm believer that any good investor out there should be able to manage their own money and make their own decisions, not based on what Greg, your smart pants neighbor, told you. Which is why today we're talking about investment fads. More precisely, the 3 F's of fads: fashion, food, and fitness. Quick shout out to this awesome podcast, the best one yet. They first shared the idea of the 3 F's, and it just got me thinking that we should talk about that.
So Jack, what's the takeaway for our buddies over at Champion?
Beware of the 3 F's of fads: food, fashion, and fitness.
Look, we've all been tempted by that new stock on the block. Well, this insight will help you not jump off the cliff because your buddies told you to. See, Mom, I can think for myself. Here's how we'll break it down. First, we'll have a look at each industry. Then we'll go through examples of companies that have proven to be fads. And finally, we'll tie it all together with a piece of investing wisdom from this guy, Warren Buffett. And we're going to do all that using the investor's favorite thing, ratios. I introduce to you the fad ratio, which is the level of peak hype divided by how often the company is used as a joke. A high FR proves the company was a super fad. A low FR that the company was not a fad. Just so you know, this ratio is not a real thing, but maybe we can make it a real thing. Ready? Well, giddy up. First up, fashion. I don't need to say much. This industry is fast-moving and trend-driven. What was once cool isn't anymore. I'm looking at you, skinny jeans. Trends come and go like this, and consumer preferences are ever changing. This is an inherent risk when investing in companies in this industry. Companies, they always need to keep making new, nice-looking shoes, clothes, hats, and so on. This need to keep coming up with the hot new thing, otherwise you're done. This is where the devil lies. Fashion is always changing. Who's to say that this company will keep up and remain trendy? You don't know that. Allbirds is a clear example to this. Remember when Allbirds were the sneaker? They were super popular with their eco-friendly wool shoes. The tech bros, celebrities, even Obama had a pair. And yeah, he did look good in them. They weren't just shoes, they were almost a movement. But today, their stock has crashed and the company is struggling. So what happened? When Allbirds went public in 2021, investors were hyped. A sustainable sneaker brand with a cult following seemed like a slam dunk. But like so many pandemic-era IPOs, things didn't go as planned. Since its debut in the stock market, Allbirds shares have plummeted more than 98%. Why, you may ask? A mix of slowing demand, high costs, and expansion plans that backfired. Like many fads, the hype wore off. What was once dubbed the most comfortable shoe in the world became just another sneaker. And with competition heating up and customers moving on, Allbirds is now scrambling to stay relevant. Now, using the fat ratio for Allbirds, let's think. This company was very, very hyped. So the first part of the ratio, yeah, very high, very high. The second part, darn tech bros, I think they made the stock be super mocked. So pretty high as well. So yeah, the ratio, I guess, the high value is going to be close to 1, I guess, because both are high. Food. While everyone needs to eat, not all foods are created equal. I'm talking to you. Pepperoni pizza. So many hypes to think of. Sushi burritos, the huge lines of cronuts, K-pops, unicorn food, that food that had all the colors in the visible spectrum begging to be Instagrammed, like this unicorn frappuccino. Speaking more broadly, you could think of the rise and fall of frozen yogurt or the plant-based meat companies like Beyond Meat. Remember when Beyond Meat was the future of food? A plant-based burger that looked, cooked, and even bled like real meat? Investors, vegans, and even fast food chains jumped on board. Everyone was convinced this was the next big thing.
Beyond Meat, the best performing IPO so far this year, up 163% on day one.
In a year that's already been chock full of IPOs, Beyond Meat is the fastest grower of all of them.
This plant-based trend is real, it's here, there's real serious demand.
Kind of smoky, has a nice consistency to it.
Is it meat-like?
It's meaty. I really could sink my teeth into it.
Yes or no? Would you eat it again?
Yes, I would.
When Beyond Meat went public in 2019, it was a sensation. The stock soared over 800% in just 3 months. Big names like McDonald's and Starbucks were testing Beyond products, and people thought traditional meat was on the way out. But today, Beyond Meat stock has dropped over 90% from its peak. The company is struggling, layoffs are happening, and fast food partnerships are fizzling out. So what went wrong? The hype was bigger than the market. At first, everyone thought plant-based meat was going to take over, but the reality? It's still a niche market. Most people weren't replacing real meat. Also, Beyond Meat was marketed as a healthier and more sustainable alternative. But people started asking questions. Why was it so processed? Why did it have more sodium than a regular patty? Health-conscious customers were not convinced. So, what's next? Can Beyond Meat turn things around? Maybe. But one thing's for sure, what was once the hottest food trend is now just another struggling company. And like all fads, the hype didn't last forever. All right. Investors, time for Beyond Meat on the fat ratio. Well, I have to say that this stock was very hyped. I myself, honestly, I thought it was going to stick around, but it didn't. So again, very hyped up. The amount of times it's used as a joke, well, I'm gonna say just because some people have made fun of me for investing on this, I'm gonna say that it's pretty high as well. So ultimatum, super fad. Last but not least, fitness. Aside from a new diet that comes up every single year, now and then there's a new fitness related stock that's super trendy. I recall not long ago, the thing was to exercise wearing these electric vests. I'm like, what? But really, the biggest and latest fad on fitness is Peloton. They were huge during the pandemic. People thought gyms were dead and at-home fitness was the future. And honestly, I felt the same. No one knew what the new normal was going to be. Then Peloton came with these fancy stationary bikes and live stream classes, really pushing you like hup hup. So much so that during COVID, it felt like everyone was buying one. The stock soared to insane levels. But today, same old, Peloton stock has crashed over 95% from its peak. The company is bleeding cash, cutting jobs, and desperately trying to stay afloat. So what happened to them? Well, a few things. They were overconfident. Peloton's leadership thought the growth would never slow down. They ramped up production, built new factories, and even refused to discount their bikes, convinced that demand would stay high. Spoiler, it didn't. Also, they were freakishly expensive. Peloton had always been a luxury product, but a price tag over $2,000 seems a bit much. And with inflation squeezing people's wallets, we all remember that 9% inflation. Dropping thousands on a stationary bike? Not exactly a priority. Oh, and then there were the PR disasters. Sex and the City reboot literally killed off a character on a Peloton bike. Come on. Which every investor reasonably made the link that the company sucks and the stock tanked. I mean, who wouldn't, right? But things got worse. Oh boy, they got worse. Massive recalls were made on their treadmills after multiple injuries. This definitely did not help. Peloton isn't dead yet. They're shifting focus to subscriptions, corporate wellness deals, and third-party sales. But will that be enough? One thing's for sure. Peloton went from being a pandemic superstar to just another struggling fitness brand. And like so many fads, the hype didn't last forever. Okay. So the fat ratio for Peloton. Man, just because of the live stream classes, it was super hyped, but nowadays I think people look back in time and see it as like, what was I thinking, Of course, once gyms open, people are gonna want to go back to gyms. So I guess it's also very used as a cautionary tale. So then again, yeah, the fat ratio is working close to 1 again. So yeah, Peloton, super fad. So what is the takeaway for investors? The 3 F's, they can be risky, but they're not impossible to invest in. Focus on companies that build sustainable competitive advantages and adapt to changing consumer preferences. Another way to think about this is, do you think this company will still be around in 30 years? Or let's put it this way, what do you think is more likely? That burgers will still be popular in 30 years? Or that Mediterranean food will still be popular in 30 years? You don't necessarily need to know the answer, but knowing which one is safer and which one is riskier is extremely important, so you make an informed decision and balance the risk of your portfolio. While working on this video, this one sentence came to my mind often, which is, be fearful when others are greedy, and be greedy when others are fearful. This was said by this little guy you may have heard of, Mr. Buffett. I guess it kind of relates, at least tangentially. And honestly, I think it takes a good while until you can assimilate this as a behavior. This contrarian take has helped me slow down my actions on the stock market. Never buy a stock on an impulse, never sell it on an impulse either. If everyone is acting crazy about something, take your own time and do your own research on it. I guarantee you that a company does not make or break in a day. It takes months and sometimes even years for a company to lose its fundamentals and lose its market share. Likewise, to prove itself worthy of your investment. A clear example of this is Netflix. In 2022, they had a bad quarter and everybody was selling it. Look where they are now. If you had bought them then, during that dip, you would have multiplied your money by more than 3 times. That's a 3-bagger in Lynch lingo. But anyways, that's it for today's video. If you found this helpful, prove you are a good human being by gently clicking on the like button and smoothly moving your mouse to the left, and this time softly clicking on the subscribe. Okie dokie. See you in the next one. Ciao.